Sometimes I wish there was such a thing as a buyer's strike. I wish we could reach a point of revulsion with IPOs where the underwriters just say, sorry, we aren't going to do this deal. Sadly, that almost never happens because there's just too much money involved to say no. The fees are too great. Right now, we're staring down the barrel of two hideous deals that could be damaging to the entire market. The first, WeWork, or the We Company, or whatever they're calling themselves right now. Here's a company that is quite simply desperate for money. If they can raise $3 billion in the IPO, they could also perhaps score a $6 billion loan. WeWork needs all the cash they can get because they are losing money hand over fist. Unfortunately, this is one of those deals that, let's just say, raises eyebrows. The corporate governance stinks to high heaven with some truly outrageous examples of self-dealing. The most egregious, the flamboyant CEO Adam Neumann, who's actually quite fun, to be honest, got WeWork to pay $5.9 million in stock to a partnership he controlled in exchange for the trademark to the new name, the We Company. I can't believe the chutzpah here. WeWork was a great name. He changed it to something much worse. The We Company sounds like it was coined by a 5-year-old, for heaven's sake, and found a way to profit from it on the side. Fortunately, Neumann returned the compensation, but that kind of behavior really makes me wonder about the leadership style. There are words to describe this kind of thing. I just can't say them on basic cable. Worse, earlier this summer, the Wall Street Journal reported that Neumann had already cashed out at least $700 million by selling his shares or borrowing against them. Can you believe this guy? I like CEOs who hold their stocks both after the IPO as a show of confidence and maybe even buy some. I don't even know what to say about a CEO who sells stock before the IPO. Good Lord. Even WeWork's financials seem kind of crazed. Numbers are supposed to be straightforward, but they're using bizarre metrics like adjusted earnings before interest, taxes, depreciation, amortization, and growth investments. Huh? It's a real estate company, for heaven's sake. If they're growing that fast, and they are, how can that be included as operating expenses? No wonder WeWork, the ultimate unicorn, a company that got a $47 billion valuation this last round of private fundraising, is now talking about doing a $10 to $12 billion valuation for the IPO. Incredibly, the company is trying to fix some of these corporate governance issues on the fly, and the company has fabulous revenue growth. I will give it that. So it could be attractive to the real growth hounds out there. However, I don't really care about WeWork itself. What bothers me is the investment bankers trying to jam this deal down the market's throat. And it feels like the mutual funds, hedge funds, and the individual investors are helpless to stop it. That's a problem. WeWork could hurt the entire market if it bombs. What about the other potentially damaging IPO, Saudi Aramco? The Saudis have expressed an interest in floating shares of the national oil company in what would be the largest initial public offering ever. After the weekend's attacks, I can't think of a worse opportunity. I'd expect a valuation in excess of $1 trillion. That's what they're talking about, which would flood the market with new stock, even if only they floated a sliver of it. That's not what we need right now. But the best we can hope for is a postponement. At the end of the day, if you want the averages to go higher, then it would be great if the investment bankers would just stop doing these crummy deals. Of course, that won't happen because they don't want to give up their underwriting fees. Greed. If they're going to do these unattractive deals, I hope they at least price them at low levels enough to make the stocks enticing, don't hurt the market. But even that won't happen unless the big accounts pass on either piece of merchandise. Look, every bit of merchandise out there has a level where it's worth buying. I just think the levels for WeWork and Saudi Aramco actually are much lower than either company would like. So we're unlikely to get reasonable prices for the buyers. If these deals aren't priced at cheap levels, I expect the market to get hammered on the days they come public. What can you do? How about we stop participating in low-quality or high-risk IPOs? How about we, including you big money managers out there, tell them we don't want these deals at any price? That's about the only thing that will put a stop to these extremely suboptimal and ill-advised IPOs. Stick with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.